Herzlich willkommen in Seattle. Als ich Anfang, Mitte der 90er Jahre meinen ersten Job an der Wall Street hatte, damals bei dem American Heritage Fund und bei Bear Stearns, war Dan Niles schon unter den All-Star-Tech-Analysten, denen die Wall Street zugehört hat. Seit fast 20 Jahren betreibt er hier in Seattle seinen eigenen Hedgefonds mit einem starken Fokus auf Technologie. Und genau darüber möchte ich heute mit ihm sprechen. Dan,
hey,
good to see you. Thank you so much for having me.
Oh, my pleasure, Marcus.
Wow, nice house.
Thank you.
Big day for me. I've been following you since the early days of my career. When I started at Bear Stearns in the early 90s, you were already one of the big all-star tech analysts. Are you reliving sort of a déjà vu right now? Everybody wants to talk about AI.
Oh, incredibly. Back then, it's everybody wants to talk about the internet and .com, and now it's AI, so big case of deja vu.
So how do you feel about that?
Well, I feel kind of the same way, except, you know, now I've got a few less hair and a lot more gray in it, and so you have the benefit of, I think, the wisdom of having seen a few bubbles since then.
Don't you ever sit there and go like, oh my God, not again?
No, because I think Bill Gates had it right when he said that new technology is always overhyped in the short term and it's underhyped in the long term. And that was true about the internet back in 2000 when NASDAQ went down 78% from peak to trough. And then obviously the internet's a big deal. I really do think AI is going to be a game changer for the economy. Unlike a lot of the things in the past, which is, you know, crypto or NFTs or metaverse, I think AI is actually going to be a big deal.
Do you actually think that investors or retail investors especially understand the term AI and what that means in relation to stocks?
If you see how it's impacting different people's jobs and how you do it, like I was thinking with my father, right? Every Saturday I'd see him working on his sermon. Well, if you could have had ChatGPT and said, hey, can you pull me some Easter passages from the Bible, that probably would have been pretty good for him in terms of helping him do the research. So I think it's going to come down to some people will use it, others won't. The people that use it will understand its power.
How did your father react when, you know, his son studied in Boston, went to Stanford, you have a master's in electrical engineering, and then you decide to work on Wall Street?
Oh, I was a huge disappointment. My mother would tell people for the longest time I was a bank teller. Because you have to remember, with my background, right, you have to be either a doctor, that's number one, a lawyer, or an engineer. I left, and I went into finance. I was a huge disappointment. And for the longest time, my mother would be, you have to go back and get an MBA.
You have to get a real job.
Well, you have to get an MBA, because I didn't have one. You know, I got to go back to school, and I finally got so fed up with her, I told her one day how much I made, and I said, just leave me alone. I'm doing fine.
For somebody to switch from digital equipment, one of the big guru companies back then, to Wall Street, was that a common phenomenon?
No, because back then you have to remember IBM introduced the PC in 1981. Went into college, graduated in 1990 from Stanford with my master's. So back then it was, oh, you know, you got to work as an engineer because look at all this great stuff. This thing called the PC, it's pretty cool, and it's like everybody's now getting one. And so it wasn't that common back then, but for me, I fell in love with investing back in college and decided to try it.
So first I thought that, okay, let's see 1987, the release of Wall Street, Michael Douglas, you know, everybody wanted to work on Wall Street. Dan was one of them.
No, that wasn't it. What for me it was, met this girl, and, you know, before my freshman year, and now my wife, and she started off in electrical engineering, then switched into finance, and I was looking at her research that she was doing on mergers and acquisitions and the effect of debt on the economy, and she was in this investing club for one of our courses, thinking, God, that looks really interesting. And then you brought up DEC, and as you rightly said, DEC was the Google, Facebook of its day. And then it just collapsed because they missed the transition to personal computers, where Ken Olsen, the CEO, said, well, I don't think people will want a computer on their desktop. I go, I think that sounds pretty cool. I'd like a computer on my desk. And that also showed me how fast things can change, and it got me really interested in the stock market.
Vielleicht zur Erklärung, DEC, Digital Equipment, wurde später von Compaq übernommen und Compaq wurde dann später von Hewlett-Packard übernommen. No? So a lot of mergers happening along that line. Yep. So you get into finance and investing during your early years in college. Were there any experiences that shaped how you invest today?
Oh, completely. So as son of a minister, mother was a secretary. My wife, she was on welfare at one point. Her family was on food stamps, homeless at one point. So between the two of us, we managed to scrape up $100. And we got a Merrill Lynch account where they would let you buy partial shares if you couldn't afford a whole share.
God bless Merrill Lynch, right?
God bless Merrill. I'll always have a soft spot for that. And the first company we bought was Standard Oil, because our thought was, well, oil is going to be really needed by the economies around the globe as they industrialize. And then it got bought out immediately by British Petroleum. So I'm like, oh, this is great. But what that taught me was you got to think big picture. If something is really in demand and you can get in on it, then it'll probably work out. The second one was even more important in some ways, because it was called Worlds of Wonder, and they made a talking teddy bear called Teddy Ruxpin and a game called Laser Tag. And this was back in 1988, and those were the 2 of the 10 hottest toys for Christmas. So we put some money into it, went off, did finals, came back, looked in the Wall Street Journal looking for the ticker, and I can't find it. They went bankrupt over the holidays. Right? With 2 of the hottest 10 toys in America, because they couldn't manufacture it, the management team wasn't getting it out to the stores, and so they literally ran out of money and went to zero. It's not the best technology that always wins, it's the best managed companies that are doing that technology, and great management can overcome a deficit to start.
I heard you quote that positioning and admitting when you're wrong is one of your key principles of success. Can you elaborate on that?
At the beginning of 2022, I thought Meta would do very, very well for a variety of reasons. And then they reported the January quarter, and they said on the call that TikTok was in the press release there was reference to TikTok affecting them. And they'd never mentioned that before. And I saw that and I said, I'm dead. And the stock was already down 15% in the aftermarket. I was like, you know what, just get rid of it. Just take the loss, admit I screwed this up, and get out. So I got out down 15% on the position. The next day, when it opened for actual trading, it closed down 26, and it closed the year down 64. Now, the good news is at the end of 2022, if you remember, they reported that September quarter, and they said they were going to spend billions on this metaverse. And then the stock got absolutely crushed, and the stock now, instead of 275 where I sold it in the aftermarket, now the stock's in the low 90s. And I looked at that and I said, Mark Zuckerberg's not stupid. When he sees this reaction, that's what he's planning on spending. He can come back and say, I changed my mind. So I started buying it in the low 90s. And then literally 2 weeks later, he came back and said, we're going to spend less. And now, I forget where the stock is, but it's up, more than doubled since those levels.
You were never one of the big cheerleaders of the internet boom.
I got the death threats for being too negative in 01, 02.
Well, I can imagine. I mean, it's like you're the only, we had all these cheerleaders in the tech environment and that were celebrated, literally celebrated. You stuck to your guns, and around 2000, you downgraded the tech sector. How much pushback did you get?
Oh, it was horrible. I mean, from a personal perspective, I remember people would stop me on the street sometimes and get very aggressive, saying, oh, you're making my stocks go down. And it's like telling the weatherman he's making it rain. All I'm doing is trying to tell you I think it's going to rain. And then professionally, we had clients saying, we're not going to trade with your firm because he's too negative and we own these stocks.
Yet you stuck to your guns, and you were right. The market collapsed and people lost a lot of money with especially the tech sector. Bank of America, Morgan Stanley, JP Morgan have been quite bearish. And very often in my community, people will ask, well, how could they be so wrong? But you have a very different perspective on actually judging if somebody was right and wrong, also in regards to timing.
It's a process to find a bottom. It's not an event, and it takes time. And so I look at some of the data that's come out since then. So what are the positives? Well, we've had 3 bank failures with 500 billion in assets, and that's a positive, right? You go, why is that a positive? Well, maybe the Fed slows down sooner. Yes, but the impact of that's going to be felt in lending out 6, 9 months, 12 months from now, not immediately today.
The IMF is saying that there's no big effect on bank lending so far, and so is the COO of JP Morgan.
Well, yeah, but I would also say the IMF didn't exactly come out and tell you there are going to be 3 bank failures with 500 billion in assets, and Credit Suisse is going to be in a shotgun marriage with UBS with 1.1 trillion in assets. So from my perspective, I listen to what people say, but that also helps you figure out, well, what do people believe? And if you strongly believe something different, that's your opportunity to make money.
So you're more of a tactical investor, one could say.
Well, I have a big picture view, but I've also gone back and looked at all the bear markets going back to the 1920s, and I realize you can end up with these ferocious rallies in between, driven by, in a lot of cases, monetary policy. And so you want to be very attuned to that and try to make money if you can on these rallies.
What is your key reason to expect a recession?
Because I think inflation stays higher than people anticipate. I mean, we saw Bank of Canada earlier. They had been on pause since January. They stopped raising rates. Then they realized, you know what, inflation's not coming down the way we would have thought, and they had to raise again in a surprise rate hike in early June. You saw Bank of Australia, same thing. They had been on pause. They came out and raised rates, and people weren't expecting it. And so I think inflation's just going to stay higher than what people think it's going to be for some of the reasons we discussed earlier: population, onshoring, ESG policies, and that's going to make it a lot tougher for the Fed to back off.
You see a lot of companies coming out talking about peak pricing, especially in the consumer sector, which I think also throws up the question, what does that actually mean for earnings and for margins down the road? Should inflation cool down?
We got Target, Home Depot, Lowe's. You're getting close to $1 trillion in sales when you add them all together. And they all directly deal with the consumer. And when they're telling you that middle income, low income consumers, high-end projects at Home Depot, they're all getting squeezed because the consumer are under pressure. And then you say student loans are going to have to get paid back. And then finally, don't forget, a lot of people still have stimulus checks in their bank accounts. That have gone up to $2.5 trillion of excess savings in the U.S. That's come down to about $1.5 trillion. By the time you get to the end of the year, that'll all be depleted.
But you're a hedge fund guy, right? You're talking about the S&P and the NASDAQ, but the Russell 2000 is already very low compared to all the other major indices.
And that's where I'm investing. I'm investing in names outside of tech. ESG has made it so people aren't investing in some of those areas. That's where it gets interesting because there's no capacity, and that's going to keep prices better. And people are just so enamored with AI that they've completely forgotten about this sector, and that's where you can find good valuations and areas to be interested in.
What happens if you're wrong? Goldman Sachs just reduced the risk of a recession to 25% within the next 12 months. They don't really see a tremendous increase in the unemployment rates. Bank of America expected a huge decrease in monthly unemployment starting in January. It never happened. The markets are incredibly stable. What happens if that big correction never comes?
Well, you have to remember there's one other piece we haven't talked about, which is valuations. So if you go back through 70 years of history and say when CPI is above 3%, and right now it's closer to 5%, the average trailing PE is 15 times. It's right now 19 to 20 times. So you're not getting paid to take that risk. And so that's the other linchpin part of this, is you can't look at this in isolation.
But how do PEs matter when you have a stock market that is entirely being held up by maybe 10 stocks, 10 megatech stocks? What does the PE even tell you if the index is so distorted?
The thing is, if you have any of those 8 mega cap names run into issues, now I can go through them one by one and go, these are the reasons you could have a problem with each one of them. If any of them runs into issues, the market's going to have a huge problem, because investors have been sort of sucked into these names because everybody has an iPhone, right? So how could that be a bad investment? Or everybody uses Google, or we all have a PC that has Microsoft on it. You look at some of these valuations and you go, they're really high. I mean, 2000, it's a similar situation where you can have Amazon's revenues literally doubled while the stock went down 95%. So valuations matter at turning points and if things are still getting worse. And that's why I go back to, well, you've had all these rallies in the past in the middle of bear markets when the market's then gone to new lows, even though it's rallied 20%. And in some cases, like with Apple, Apple's estimates for June went down for both revenues and profits. Now they went up for Google and Microsoft and Meta, and we own Meta. We've liked that for a while, as I've said. And so we're just trying to balance the portfolio and say there's still some risks, and especially in consumer spending, where an Apple is very exposed to that. And we've heard from now Lowe's and Home Depot and Target and Dollar General and Walmart and a whole host of companies have said, well, the consumer is feeling some pressure. And then student loans are going to have to start getting paid back in the US after 3 years of not having to pay back loans going into Christmas.
When you see a stock like NVIDIA exploding $200 billion in market cap in a single trading day, what's your take on that?
I've been doing this job for a while. It is the biggest estimate raise in forward numbers I have ever seen of a company of that size. Estimates literally went from $7 billion for the July quarter to 11. Revenue estimates went up over 50%. And if you look at the valuation, it's trading at about 50 times, but the revenues are expected to grow almost 50%. You compare that with an Apple trading at 30 times, where revenues are expected to be barely up. NVIDIA is actually cheap relative to its growth rate, and they have a monopoly almost on graphics that go into AI. So we still own NVIDIA, but it's balanced with shorts in other areas where I go, well, that valuation relative to where that stock's gone up, that doesn't make as much sense.
Buying a stock only because it's cheap is not a good enough reason. To quote yourself,
yeah, it's a horrible reason to buy a stock because it's cheap.
So what about Intel and IBM?
Well, with Intel, I think there's a different situation because they went from being a market leader in technology to falling behind. Then Pat Gelsinger comes in 2 years ago, says, we screwed up. We're going to go all in on EUV. Now they're starting to see some of the benefits from that. Intel's absolutely hated. It's probably one of the most hated large cap companies in the tech space. But they beat the last quarter. The numbers went up for revenues. I think this quarter, the CFO's already come out and said, hey, our data center business is going okay. I think partly because of some of what we talked about. I think you're going to see margins come in a lot better. People are going to need more powerful microprocessor cores. I think with the valuation where it is, it's very attractive, trading at about 1.3, 1.4 times book value.
What's your take on IBM?
They missed the top line. Estimates come down on the top line. So they do have some businesses that benefit from AI, but they've also got some other businesses that are hurt by the economic slowdown. Financial services is a big end market for them. I don't think Credit Suisse is going to be hiring them anytime soon.
Yeah.
So any company that has any hint of AI, people are trying to say, oh, it's a huge winner. I go, well, yeah, but they got these other businesses, and there was a company called EPAM. They grew their revenues 28% last year in the IT consulting space. They came out a month ago, cut their forecast and said, yeah, we're seeing a widespread slowdown in what we do, which is very similar to portions of IBM's business. And then a month after that, they said, you know what, we have to cut it by another 5%. 1 month after we just told you we were lowering it. You don't see that very often. 30 days after guidance, cutting again. So I think you're going to see some more pressure in that IT consulting space, and so I'd be very wary about saying, well, IBM is going to get through this with no problems. Oracle is a different case. You haven't asked me about that, but that's one of those companies that was considered legacy that I think is actually doing pretty well and adapting well in the AI world.
Dan, thank you so much for your time. I appreciate it. Thank you for having us.
Thank you for having me on, Marcus. Appreciate it.
So, wir tauchen jetzt ein in eure Fragen. Es sind so unglaublich viele eingegangen. Dan wird sie jetzt direkt für euch beantworten. Dan, please.
Thank you, Marcus.
Based on your recent CNBC appearances, you seem to be a bit of a cautious bull. What would it take for you to become more bullish?
It'd have to be more confidence in earnings not rolling over, more confidence in valuations being at reasonable levels, which they're not. They're pretty high. And also, finally, and the most important piece right now is having some confidence that inflation is going to get under 2%. And so those are the three vectors I'm looking at.
Let's say you missed a rally. The markets are running away. You have to play catch up. What do you do to correct the course?
I just look at what's going on today and think there's still much more downside risk to earnings. Valuations are still very high by historical standards relative to where inflation is. And so I'm not that concerned that the market has gone up a lot. We caught a good portion of that rally. This last, couple of hundred points on the S&P has been surprising to me that it's gone up this much. But as long as earnings look like they're going lower, which I think they are for the broader tech landscape, then for me it's just being tactical and dealing with it that way.
NVIDIA's market cap is now bigger than the entire market cap of the Euro Stoxx tech index. When compared to the United States, are there any relevant AI players in Europe?
Well, the one I'm really excited about seeing is when ARM comes public. And if you remember, NVIDIA tried to buy ARM. That's how important they thought that technology was. And ARM is used by both Google and Microsoft, which are at the forefront of this whole battle for generative AI. And because both of them use those cores to build their own chips. So when ARM comes out, that's the one that I'm going to really look to buy that's based in Europe.
Many of the AI-related stocks are priced based on hope and not on facts. What quantum leaps in tech are necessary to accelerate the adoption process?
It takes time for technology to diffuse through economies, through industries. And so the ChatGPT moment, nobody was talking about that 4 months ago. And all of a sudden it just bursts onto the scene, and then every CEO is talking about it and how to use it. And so we've gone to that moment of realization that this is a big deal. And people in my industry call it the iPhone moment, right? When Steve Jobs pulls the iPhone out of his pocket and that just kind of changes everything. ChatGPT is the same thing. And so I think it's just giving it some time to play out.
When will AI hype run its course, or are we just at the beginning of a justified boom?
So the answer is both. And what do I mean by that? Well, you go back to 2000, clearly the internet was at the early stages. But that didn't stop Amazon's stock price from going from $106 a share to $6 a share at the bottom. And that was one of the lucky ones. You had about 4,000 internet companies go to zero during the tech bust, and it took about 2.5 years to find the bottom, and NASDAQ went down 78%. Again, 78% for the NASDAQ index over that period of time. Now, it's clear that the internet kept growing over that 2.5 years, and it's even bigger today, but it doesn't mean that you can't go through a colossal bust. And to your point, I think you are going to see a big shakeout as we go through the rest of this year, because everybody's thinking, oh, this company's the next NVIDIA, and we're going to see revenues get revised up by 50%, earnings revised up by 100%, and that's just not going to be the case. And I think, unfortunately, a lot of investors think that that's going to happen with everything painted with AI.
Many are calling for the need to regulate AI. How would that affect the industry's growth? And judged from past actions taken in the social media and crypto space, how effective will that actually be?
With any new technology, there's good, there's bad. You're much more likely to die in a car accident than if you were in a horse and buggy. But I don't think any of us debates that a horse is much better or an airplane is much better. So I think with AI, at least from my perspective, I view it as it's a very important technology. We need to do as much as we can to advance it as fast as we can. Obviously, you need some regulations around it, but I hope that it's pretty light, because having government officials trying to regulate the technology industry in general, I view that they do a pretty poor job.
To what extent will AI increase productivity, and how will this affect long-term inflation?
I think it's going to be a huge boon to productivity. I know a lot of people are worried about jobs disappearing, and what I see more is the jobs are just going to be changing. The Luddite movement in the early 1800s, there was the big protests about all this machinery and it's taking all these jobs, and I think we can all agree that life's much better here in the early 2000s than it was in the early 1800s. And so I think, are you going to lose some jobs? Absolutely. But are you going to have new jobs created where people are going to have to learn how to give the right prompts? Because if you don't ask the right questions, you're not going to get the right answers. And if you don't frame the questions properly, you're not going to get the right answers. And so I think the real leaps in productivity is going to be a person with a lot of knowledge armed with AI to make their ability to be productive that much greater.
You experienced the boom and bust of the dot-com bubble, and you were one of the all-star analysts back in those days. You downgraded those stocks just in time before markets turned sour. How does the dot-com bubble and burst relate to the current environment?
Well, I think there's a lot of good analogies there, and people probably forget. Apple, which you could argue invented the personal computing industry, almost went bankrupt. And people forget that. If it wasn't for Microsoft buying 25% of the company, it wouldn't exist today. And so in the technology industry, you end up with the leader of yesterday a lot of times being displaced tomorrow. So you can think MySpace displaced by Facebook, you can think Netscape displaced by Google, you can think BlackBerry displaced by iPhones. And that's the wonderful thing about the tech industry is it keeps changing, it keeps evolving going forward. So you may be bullish on AI in the long term, but if you were bullish on Webvan instead of Amazon back in 2000, you had a very different outcome in your portfolio. And so I think you need to keep flexibility in your thinking and also pay attention to valuations and profitability.
You recently called the tech industry, tech stocks, a minefield. Can you elaborate on that?
It sort of relates to the answer to the prior question, which is there's no question AI is going to change the world in ways that are going to be absolutely wonderful. But it doesn't mean you're not going to have a tremendous amount of companies like in 2001, 2002 go to zero.
What do you think is the biggest risk to the stock market? Disappointing growth or inflation being sticky?
I think it's both. I think inflation is going to be a lot stickier than what people think. And so the three things you can look at is China had their population shrink for the first time in 60 years. ESG policies are great for the environment, but it also means that energy costs are much higher at the same time. And then finally, looking at China and saying, well, we might want to have production onshore instead of sitting in Taiwan. That's great for your security, but it's bad for costs of building these chips. And so that's why I think inflation over the longer term remains higher than it has in the past.
How do you see AI being able to predict and self-maneuver the stock market?
It comes down to this. Already you're seeing machines running much more money. I think going forward you're going to see a greater proliferation of that. But you're going to still need, I think, a person armed with AI as a tool to make it function the best. So it's already being in use. It just means it's going to proliferate more going forward.
So looking into the future, you see all the human-like robots being developed. Optimus from Elon Musk, for example. When are we going to see these kind of robots marching among us humans, and how will that actually change our lives?
Well, I mean, I think you're already seeing it. So for some of the most dangerous jobs, they've already got robots that handle things. So for deep underseas, putting out fires on oil rigs, and in factories doing some of the most dangerous jobs. And so the thing with AI is it's going to make those robots be able to be much more autonomous and be able to react much more quickly in dangerous situations. And so I think it's just continuing along the path that we're already headed.
Thank you.